Breaking the Mould, our regular look at the financial markets with Investment Director Russ Mould. Russ, you're back fresh from holiday?
Yes, feel very invigorated, thank you.
Okay, so I have to ask you the question, Russ, what is the fuss?
Okay, well, it's not the busiest week ahead that we've ever seen, but there's still going to be plenty of fuss, and it's going to be caused by three things: house builders, insurance, and tobacco. And that's because we've got results or trading updates coming from three FTSE 100 companies. So there's no messing about, and they are interims from Persimmon on the 18th, interims from Admiral on the 19th, and a third quarter trading update from Imperial Tobacco also on the 19th.
So it is looking kind of busy.
Yeah,
but
it's busy enough. Three FTSE 100 firms.
We should start and build some firm foundations and get stuck into bricks and mortar.
Well, that must mean then York-based Persimmon, where July's trading update, and for that matter, an upbeat early August commentary from Pierre Bellway, they've already given us a flavour for what to expect from Persimmon's first half numbers. Now, in the trading update from Persimmon, completions in the first half rose 7% and sales rose 12%, with average selling prices up a healthy 4%. Cancellations very low. Total forward sales up 15% to 1.4 billion quid, so visibility is very good, and the firm's still generating cash, even as it buys more land for its land bank and returns cash to shareholders in three large payments. So in short, the numbers are going to be pretty good, and it'll be interesting to see what boss Jeff Fairburn says, if anything, on the government's plans to launch the Help to Buy ISA for first-time buyers, and I think that goes live autumn, maybe even December, I think. Now, what investors, though, have to fathom with this Persimmon is what's already in the valuation. The figures are going to be good, but the chart behind us shows the shares are trading at a 10-year high at least, although forward PEs of 14 times this year, 12 times next, not too challenging under the circumstances, kind of level with the market overall. Okay,
next up then, it's insurance. It's fair to say that this chart means,
yes,
the Admiral has encountered some choppy waters this year.
Who writes your script? Anyway, so very good. The graphic does show there's been a bit of a dip, and sentiment did take a knock back in May when Admiral's founder and chief exec, Henry Engelhardt, announced he's going to retire as of January 2016. Now, nobody saw that coming, but the transition should be smooth enough, as the new man at the top is going to be current Chief Operating Officer David Stevens. Now, he's been with the firm since 1991, just 2 months less than Engelhardt himself.
Okay, so there shouldn't be any unforeseen accidents there. So how's the underlying trading?
As you hint, Admiral is a non-life insurer, and the Cardiff firm is a specialist in car insurance. Pricing here has been awfully tough. Great for consumers, but not fab for Admiral. And in 2014, the company's profits fell year on year for the first time, well, basically ever, or certainly since its 2004 flotation. The UK has been especially brutal, but the Italian business Conte is doing well, and the European price comparison sites, Rastriator and Lilinx, and I hope I pronounced those correctly, are doing okay as well. The good news from Admiral's perspective is a July survey from the AA suggested car insurance prices have actually started to bottom and rise again after a 5-year price war. So let's see if Admiral makes any reference to that, or indeed numbers from rival eSure, which early in August said it would start to push up premiums to defend its profits after a rash of small injury claims. Now, for 2015, Admiral's earnings per share are forecast to drop 10%, second straight decline, although the combination of dividends and special dividends means the stock yields around 6% at the 1470 mark. That might be enough to interest some, especially if those price premium increases stick.
Okay, so that's insurance done. That just leaves us with tobacco.
Tobacco, and that's a third quarter update from Imperial. May's interims were so-so, I think it's fair to say. Volumes fell 5% on an underlying basis. Sales and profits both slipped slightly according to the reported numbers. CEO Alison Cooper flagged weakness in Iraq, where apparently ISIS don't like people smoking, in Vietnam, as well as France and Spain, but its key brands overall did pretty well. Better still, there's a £300 million cost-cutting drive. That's actually ahead of plan. Cash flow's good, and the firm's finalised its £4.6 billion purchase of a US-based business, which came up for sale when Reynolds American bought Lorillard. All of that gives Imperial a much better position in the US than it's had previously. Now, long run, it's kind of tough to see why cigarette volume should rise. Public smoking bans, advertising bans, plain packaging campaigns, e-cigarettes and so on. But industry consolidation, good cost control mean profits could stay high for a good while yet, at least if the share price is any guide. Imperial's making pretty good progress looking at that, and analysts expect earnings per share growth of 2% this year, 12% next. The firm's also got a great record of growing its dividends, And this year's consensus estimate of around 142 pence a share is enough for a yield of kind of 4% at current levels.
Okay, thank you, Russ.
Pleasure.
And thank you to you for joining us. We'll see you next time. Goodbye.